So, I'm assuming you glanced at the title of this video and you saw that I'm going to be showing you how to identify and draw trends and trend lines. So, let's start with the first thing. We've already learned how to draw horizontal levels, remember? So a price just comes to an area and it bounces, and then it comes there maybe like a second time along the same area and bounces, and then maybe a third time. And so when you see price start bouncing in an area, you just draw a horizontal line, and I showed you the details of how to do it, when to use a zone versus a line, things like that. And all that stuff, it should be pretty simple because you're keeping it simple. You're just looking for the most clear areas where price is breaking and retesting. And so that's for horizontal levels. What about diagonal levels? So let's say the market is going, and making like new lows, and it's making these lower highs, and it's going down, and it's making new lows, lower highs, lower low, lower high. It just keeps going down. And so you just connect all the tops of these, and essentially like the idea is that, price is just going to keep on coming and reacting at those areas and falling if price is going to sustain moving in a downtrend. And don't get me wrong, sometimes weird stuff happens, like price pins past an area and then comes back, and then it falls and then keeps going down. And this little spike right here confuses everyone because it broke out above those. But essentially a trend is just looking at the overall direction of the market, asking yourself, is it moving up or down? And answering the question with it's moving up or it's moving down. So an uptrend is simply when the market is just making new highs and higher lows. Very, very simple. It's going up. Downtrend is the exact opposite. So if the market's in a bearish trend, it's going down. And if the market's in a bullish trend, it's going up. But the market just either goes up or down. And then the market also goes into sideways consolidation, which we just call ranges. Like if the market's in a range, it's bouncing up and down, but it's not really making new highs and it's not really sustaining new lows. It's just kind of going sideways overall. And we're going to learn about that in a separate video. So for this video, let's talk about trends. The cool part about trends is they're essentially the same type of levels you're drawing as horizontal levels, except we're just drawing them diagonally. So here's how you do it. All you do is you go to the daily in the H4 chart. So I'll put the daily here and the H4 here. You're going to start on the daily, and you're going to identify any clear trends in the daily. And remember, we're going to want to look at the most recent price action. We're going to draw our trend areas at the areas that are closest to where price is currently at, because that's what's most relevant to us. We don't care about something that happened like 3, 4, 5 years ago as compared to something that's been going on like the last few weeks. That's more important. And so the daily in the H4 chart, does that look like an H to you guys? Sorry, my 10-year-old drawing skills are about to be almost as good as 11-year-old drawing skills. So hopefully, hopefully I'll upgrade my drawing skills here pretty soon, my MacBook trackpad. But essentially, the daily and the H4 charts are all you're going to use for this, same as horizontal levels. And you're just going to look at, where the market has made highs, where the market has made lows. And you're just going to identify, where those highs are at. And if those are all the highs, you're simply going to draw a diagonal line connecting all those highs. So let's go look at this on the chart. Here, as you guys have already seen from the horizontal support resistance video, remember I had this little trend right here on the GBP USD. If we're going to the daily, there's no clear zone in the daily except maybe if we took this low right here, connected it to that low right there, and we extended it into the future with the idea of, hey, if price comes into this area in the future, we could see price react right there. And if price were to come there in the future, we could start looking at maybe this horizontal area here because price bounced on it one time and a second time right here. So if price came right here and it bounced along this like horizontal support, along with maybe this upwards trend line, if price bounced along them both and started trying to go up, we could make a logical guess that, hey, it looks like price may try to continue up for the next move, and you could look to profit off that. However, drawing trends, we just want to draw them more than the most recent. So in the daily, that could be a potential trend if price came there. And that's really all I see on the daily. The only other stuff I see is connecting that high to that high right there. And then in the future, if price came to this level and started respecting it, it could have, shown rejection. And it looks like price came up to this level and just smashed through that level and then tested and started continuing upwards. So that level, it looks like, price broke out of that, what would have been a downtrend. You could have maybe drawn it like that as well to connect, that point right there as well. So then you have 1, 2, 3, and then 4 touches of that area. Wouldn't have been a bad idea to go short right there either on the market, or place a sell position. Going short, placing a sell, it's the same thing. And so, but that is not what's going on right now. What's going on right now is this upwards direction right here. And if we're looking here on the daily, what does it look like price is doing overall? It looks like price is going up. If we start from there and we look at where price is at now, price has been going up. So, that being said, we also go to the 4-hour and we look to see what price is doing on the 4-hour as well, and if we can see any clear trends. Now, one thing about trends, whenever you're looking for price moving in an uptrend, all you are going to be doing is connecting the lows. Okay, you're not going to connect the tops and look to take buys based on the tops. You can draw in the top, which is like a channel, like a range upwards that price is moving in. However, it's not necessary to determine a trend. You don't draw it on top. If it's a buy and price is like moving upwards and you're looking to buy, then you're just going to be drawing this trend line on the bottom, connecting all the lows. And the same thing with a sell, vice versa. If price is moving downwards, you're only going to be connecting the highs, just the highs. You're not going to worry about the lows. I'm going to go into later about, like ranges and stuff moving downwards and channels. And, it's likely price may reach that end of the channel and come up here and then touch the top of the downtrend and then come lower. But that being said, it's not necessary to determine a trend though. When the market's moving downwards, just connect the highs. When the market's moving upwards, just connect the lows. That's it on the daily and H4. Okay, so right here, if we were to connect all these lows, we could start right here and, whoa, that was a ray. So we could start right here and then connect it to these lows right here. And if we extend it into the future, we can see that price came into this area, kind of dipped below it, and then bounced upwards. And so we could say, if we're curving it down to cover that wick right there, then we can show, okay, looks like price is reacting right there. And if you pull it even further, you can somewhat say that hey, price started there and bounced right there, and then second, third, fourth, fifth, sixth time. And that works. You can do that. Here's one of the things you should know about trends is that they can be, drawing the actual line, the trend line, can be very subjective. And so what you're going to do is you're going to use the data that price has painted on the chart, which is what these candlesticks are doing. You're going to use what the candlesticks are doing and what the price is telling you and what the candlesticks are telling you. And that's how you're going to draw your lines based off of. So as we know, price, bounces around with these candlesticks, and sometimes they'll leave these wicks or pin bars. Like if price went all the way up there, but then quickly got pushed down and closed lower, like right here, price will leave that wick right there. And then let's say, price goes down and then it comes up. And then right here, price, leaves a wick like that. And then price goes and it makes a low, and then price comes back. And then it maybe makes a candlestick like that with just a smaller wick. And so then you may ask yourself well, how do I connect these? Do I connect it from the wick all the way to that wick right there? Or do I connect it from that wick, and then do I make it slash through the candle to the close of the candle and then do it like that? Which way do you do it? And here's the answer. There's no right or wrong way. Some people swear up and down you need to do it wick to wick. And there's a lot of truth to that because, if you're doing a wick to wick, you're probably not going to be getting in trades too early, because if you're waiting for price to come all the way up there and then show a pin bar, then that totally works. But the thing is you might miss out on a lot of really good viable trades if you're just waiting on that stipulation right there. Because let's say that price goes right here and then it maybe comes up and respects it again in here and comes down, goes up, makes that candle right there, goes up, respects it here, and then here, and then here, and then here, and then here. If price shows that it's just respecting a level like that with a trend line right there, but you've got your trend line drawn from that wick to that wick, and price isn't even coming up near there and then starts bouncing at it, then the real trend line is probably this one right here where price is respecting more. And let me give you an example because this is all conceptual. Let's look at it in terms of the chart. Let me draw two variations of what this trend line could be. The first variation could mean if we're literally just doing wick to wick, you could start at the wick of that candle, connect it to the wick of that one because that's the absolute lowest it's been. and you'd get left with that line right there, this one right here. So you're left with that, and you see price sort of broke through it and then went above. However, you could also do, if you went from candle close, which was, let's just start right here, candle close to these candle closes like that. Then it looks like price broke out of the trend and then came up and tried to test it on the lower side and then fall. So now you're left with two situations. You're like, okay, did price break out of its trend right there? Or is it like going to respect it and go back above it and test and then go up? Or what? The way I do it is I just look at what price is doing and I draw the trend line and I kind of like manipulate it around to just show where most of the data is hitting. So if most of the price data is hitting this trend and it's got like 1, 2, 3, 4, 5, 6 areas of interaction, that is going to be the area I draw my line versus an area where price only interacts with that trend line like maybe 2 times. So for instance, if price does this and then it's going down, then it makes a crazy weird spike, but then it goes down and then starts doing this. If you're drawing your trend line like this and connecting these lows and it slashes through that one, but it still goes and it connects with these, and let's just assume that it, bounces along the trend, and then it comes up here and then it just starts respecting over and over. That is a trend line I would draw versus a trend line from this extreme high all the way to this extreme high and then extending it like that. Because if price is like reacting along this one right here and it keeps bouncing along that one, that's probably the trend line that's more important versus this one right here where you did the wick to the wick. Now sometimes like the wick to wick will be like the better trend line, but it all depends on what price is doing. And the way you make that decision is simply by looking at the chart and asking yourself, like, where is price respecting more? Is it respecting like this one right here or this one right here? Like which one? Where is more prices coming in, like bouncing away from that level? And whichever one's respecting more at, that's usually the one that you should use for your trading decisions. In most cases, it will result in a lot better trades. Okay? So let's go look at another example. Let me just scroll back to a random part of the chart. Okay. So downtrend. So if I'm just keeping it simple, I'm going to start up here with this high, and we can see prices like this is a lower high. These are lower highs. It's a lower high, lower high. These are all lower lows going downwards. So, this market's clearly starting to go downwards. So I can draw it like that. And that is the absolute most like extreme high up there at the top to that extreme high right there. And that is it. And it looks like it went all the way here into the future to like right there. But for now, there's that trend line. Now, let me give you a second variation of this. What if we did that high, connected it to this high right here, and we use that trend line? So, which one looks like it's more respected? We'll call, this one up top, we'll call that number 1, and we'll call this trend line right here the second one. Which one is more respected, 1 or 2? Well, it's clear that the second one is more respected because price interacted once right here, 2 times, 3, 4, 5, hit this area and then reacted. So just this area right here, we'll just call that 6 times because price went past it, but it ended up coming and ultimately respecting the area. So it's like 6 times, 7 times, 8. So we can do like 8, 9, 10, but let's just call that 8 right there. There's 8 times right here where prices respected this trend line versus what about trend line number 1? Well, there's 1 touch right here and then 1 touch right here, and then price just kept going. And you would have never gotten a chance to capitalize on that downtrend if you were using that one. And so in this case, worst come to worst, whenever you're drawing trends, if it gets confusing or you're kind of wondering like, which one is it? If you have to, just start from the absolute biggest high that you can find within the trend and then draw it, connecting like a variation of events, like maybe like 1 or 2 or 3 different scenarios. Like right here, I have, 2 different scenarios where, hey, it could be this one on top right here, or it could be, this one on the bottom. And I don't know. So sometimes like just connect like, maybe 1, 2, or maybe even 3. Sometimes you'll have a really weird scenario where an uptrend or downtrend, you'll be able to draw like 3 trend lines and just connect it and then like manipulate those lines in a way to where they include the most price data, and then the ones that are not that relevant, delete them off the chart, and they're not relevant based on how many interactions. So a trend line that has more interactions, that's probably going to be a lot more relevant and more useful as compared to a trend line that doesn't have that many interactions. For example, that to that right there, that low to that low right here. For one, if we go out on the bigger time, like the bigger grand scheme of things, this you may not have known it was in a trend, because right there, that's all you would have had. So this kind of looks like it's going sideways. But for instance, like further down in here, you could have been drawing stuff like this, like thinking the market's going to go in an uptrend. But always remember, like the daily and the H4 are the ones that set the precedent for what's going on. So don't be trying to like draw an uptrend and trade buys based off like, like this move right here because you're zoomed in way too far. Go out and look at the big picture and just simply ask yourself, is it going up or down? And if it's going, in this case, down, just draw a line connecting all the highs here on the daily or the H4 chart, and connect all those highs in a way where you can like manipulate it to like show like, hey, most of the price candles are coming and rejecting at that area. And that right there is a lot more useful as opposed to something like that. Whereas, you have to wait for price to get all the way up there when price is clearly interacting with it lower. So that is how you draw the trend lines. You just connect them where they're the most relevant, I should say. You can call it whatever you want, but it's just the area where price is interacting with most. Okay. So that's for a downtrend. Let's look for an uptrend. Let's see if GU has clearly not been an uptrend for a while. Here's an uptrend. So let's just say you got on the charts back in, what is this? 2014. Where is this? Yeah, so that's 2014. So April 15th, 2014, you started looking at the market right there. And then you look, okay, the market's clearly in an uptrend. How can I better define this trend to show, like more relevance? So what you'll do is just go to the extreme low, the lowest low you can find within that trend, connect it to the next low, and you'll have something like that roughly, right? So then you also see, well, hey, price goes out and like funnels out right there for a second. What's that all about? Draw your trend like that and see like, okay, well, is that the real trend? And then if you want to do a third one, then you can go like, just draw that extreme low to that extreme low right there. So out of all these, where is price respecting the most? This first one that I drew in here, or the second one, or the third one? Well, in my opinion, it's easily the first one, because the first one just has the most interaction. This second one has 1, 2, 3, 4 key areas of interaction. Whereas if we just look at that first one right there, market's clearly going upwards. If we connect that low right there, and then we sort of drag this to like show where it's like respecting more areas, we've got 1, 2, 3, 4, 5, and then somewhat here for a second 6, but it didn't really bounce right there and take off. Let's just say we've got 5 areas of interactions. You would have been so safe just waiting for price to just come to that area and bounce. And, it's just a very clearly defined trend because you just connected that low and that low and that low. And you just sort of, curved and angled it where it needed to be and just made it to where it was including most of the price data. And that's it. And all you're going to be doing is just going to the daily and H4 to do this. That's it. So here's another one right here. Just take, an extreme low, connect it to like the second low and drag it up. So if we were to do that, we connect that. But what about this area right here? Price still interacted with that level, right? So let's just examine that and see what that scenario could be. So if we examine that scenario, it looks like price was going along that area, broke below it, tested the underside of it, broke back above, tested the top side of it. Then it came and broke lower and this and that. So where is price interacting with the most? It looks like this top one right here. So that's where I would have had mine, because that's just where price is interacting with the most. And it's going to be very simple, because just like you said, how I drew 1 line and 2 lines and 3 lines, you're just going to draw that out and just ask yourself, where is it hitting the most? And the line that it's hitting the most, just use that one. That one usually works the best. And in this case, we had a lot of interaction, like 1, 2, sort of 3. Didn't come all the way down, but let's just call it 3, 4, 5, 6, 7, 8, but let's just call this, this area like 4. And then right here it broke. Then it came back above and started testing it again in the future. So this right here, another thing is whenever you're trading, as long as you know the original direction of the trend, whether it's the daily in H4, you're not going to be looking to get into sells until there's already a clearly established trend. So whenever you're trading, what you'll see is price will typically, go in an uptrend. And then whenever it's ready to be out of that uptrend and the market's just not going to go up anymore, it'll generally reach a point where it can't get past it, break that area, come up and test like the trend, or maybe it'll test like a horizontal level like that and start falling. You don't really want to ever be getting into trades right here trying to predict a new trend when the market is already in an established trend. What you want to do in that case is when the market is going upwards, even if it breaks out of that uptrend line, you still do not want to be anywhere looking for selling, because there may still be people waiting for like the market to like come to like a lower. That is so bad. My drawing skills. People may be waiting for price to come to like a trend line that's lower, a trend line that was painted that, price may come down here and then react with that trend line and then go. So whenever you've identified the overall daily and H4 trend, even if it breaks out of that line technically, don't be quick to try to like jump in on sells or try to sell the market and thinking the market's just going to drop from there. Because while it may do that sometimes, it may go downwards. During trends, there can be plenty of times where the market will just fake you out and try to get you to sell. And if you're taking sells whenever the market's clearly overall bullish, you're just not going to win as much as opposed to if you were to only look for buys than an uptrend. And you know what happens if the market is going to go in a downtrend? It'll find a support. It'll break that level. It'll come and retest as resistance. And the market will go down and start, making a new low, come up to a previous area, find resistance, and then it'll start making a downtrend. And then after that is already clearly established, like after you already have like a downtrend clearly established, meaning just lower lows and lower highs, and you can connect all the highs and it looks like a downtrend, that's where you get into sells, is after it's already clearly established. So for example, this, you'd only be looking for buys in here. You wouldn't be looking for sells. Then right here, if you would have had this low connected to that right there, and you would have been looking to try to sell right here, if you sold somewhere in here, this one might have worked out. You could have won. But what about right here initially where price was going in this? Let me take this off to me. Price is going right here, and then it broke out of this area and then came up and started retesting and then tried to go down. And then you connect all these and you think like, yeah, okay, it's gonna go for a sell here. And so then you start trying to like sell up in here. And then this one you would have lost this trade because then it kept going up. Because the overall direction is clearly up. So you don't want to be jumping in something when the direction's up, even if it technically breaks those lines. Because a lot of this stuff will happen. Sometimes it'll break levels, but it'll just go and like retest the previous lows and start bouncing. So the takeaway from me explaining this right here is saying like don't try to counter the market if it's in a clear direction. Like for instance, if the Great Britain pound is just banging downwards and GBP USD is just going down and down, and you've got your trend right there, and then all of a sudden it breaks out of that trend and then it looks like it's like trying to start going up, do not be quick to buy. There may be people who disagree with me, and that's okay, but I'm telling you this from personal experience. Do not look to try to chase new trends. And the simplest reason is just because it's so much easier to just wait for a clearly established trend and then trade with that clearly established trend. There's no reason to try to predict reversals, or breakouts or anything like that. Just wait until you've got a lot of momentum and price is really just moving in a nice, easy to identify trend, and simply take trades like that. Your trades are going to be a lot higher quality. You're going to be a lot more peaceful. You're not going to have to worry about like, oh my God, is this a fake out right here before it crashes back in and then goes downwards? Or is it an actual real breakout that's going to like hold and go up? Here's what you do. If price breaks out, and it's been in a downtrend for a while, don't be quick to look for buys. Just let it do its thing. And if it goes up and then it starts breaking these areas and starts forming a new trend, and then it starts, gathering momentum and going up like that. Once it starts forming a clear trend and you can clearly draw, and prices like respected a new trend a couple times on the H4 chart, then, it may be like a good time to start looking for buys, because then you can buy in there, stop below here, target up here or here, You can take some profits and keep it holding. You'll learn all this stuff, later on in the course. But wait for a clearly established trend to make trading decisions. Don't try to chase reversals and stuff like that. This is all stuff you can test later on once you get profitable trading the simple system, which is my system is, breaks and retests during trends. Once you get good at that and you're fine with that, you're really comfortable, it should take you a few months, then maybe you can jump into stuff like trying to predict breakouts and stuff like that. But it's in my opinion, it's just not even worth it. Like why offer needless complexity trying to chase something when you can already have a good system that's very simple, that's very it's not a pain in the ass, and it's just so simple to do over and over and over, and you're just looking for like 2 or 3 things. Like, why not just do that? That's the way I look at it. However, let's look at what happened here. Price, by all definitions, this clearly just broke out of its uptrend. So even if we were to connect that low to that low right there, which would have been more relevant at that time, you could have adjusted it as price came to right there to say like, hey, where's price going to interact at? So price came to there. Looks like it just broke through it and then started going downwards. So after it started going downwards for a while, that's when I would have started to say, all right, looks like this uptrend's over. Price is going down. So then what you could have done is you could have connected like all the highs like that. And let's just say price was like right here whenever you saw it going. You could have drawn like, all the lows in. So there was some lows right there that would have acted as support. Low right there. Low right there, and it went all the way down and put in a low down here. And the price was just going up and up and up and up and up. And all you're looking to do is just trade breaks and retest of horizontal levels during a trend. So this new trend would have been downwards. Let's clean it all up and like look at what it would have been doing in there. So we don't need any of this extra stuff. We don't need any of this up here. We would just be looking at what price is currently doing in the moment. For instance, if it was like right here, price looks like it spiked out of that trend, but then it came back and started respecting it. So the trend line still looks fine right there. So you can still leave it right there with the idea that, hey, it's still respecting this area. Try to get past it, but just came right back into the trend. That's why I don't try to like anticipate breakouts, because if you would have bought right there thinking that it broke out of the downtrend so it would have gone up, this happens like quite a bit, is it'll just come right back into the trend and then the initial wave of, the downtrend will take over again. But let's say, it rejected that downtrend. Then all you do, you just look for clear areas where price is bouncing at. So this looks like a support level. Wait for a break and retest. And right here, it broke and it retested and it started coming down. Same thing right here. There's a low right there, broke, retested the level and then started coming down. Same thing right here. There were some lows right here, broke, retested. That one might have been kind of hard for you to see, but broke, retested, fell lower. There's another level right here. Broke and retested. This one, if you would have taken for a sell, it might have gotten stopped out. So what you're going to learn is oftentimes what I teach in the course is you always want to use trends in confluence with horizontal levels, and you only want to take trades after they come to a clear horizontal level and diagonal level and start reversing at both of those areas at the same time, because those are where you're going to get some of your most high quality trades. Let's find an example of this, something really clear. So if I were to take this extreme high and connect it to that, how would this work? That looks good. We have price interact there. 2. This was sort of a fake out, but this, we could count that as 3. So let's just count this like price came and tried to get above, but it still fell down. So it still sort of respected that area. We'll take off all the extra fluff that we don't need, because down here in this area, all that would be mattering is this right here that's going on. We'll adjust the trend line to include those wicks right there. So it's like 1, 2, 3, 4, 5, and then maybe price came up to here. Well, this last area, the last set of lows, it would have been probably these guys right in here. The last set of lows, and the price came up to this area, retested the trend line as well as those previous lows, which is now acting as support because it bounced 1, 2 times here as support. Broke that area, came up and retested that along with the trend line. Trades like that work so much better, because you can have, entry, say it starts going down. So you had your entry somewhere down there. Your stop just goes, above the trend, above the previous highs. You'll learn all this in detail in the break and retest section of the course. But something like that, would have worked out. This one would have taken a while to work out, but it's also here in the H4 chart. But price still just kept hammering downwards. And this is another reason I say don't try to counter the breakouts. Because if you're trying to predict a new trend, look at what would have happened here. Price would have broken outside of the trend right here. And so then you might have been thinking like, okay, so is the downtrend over? Is it safe to buy? And so then you may have like been trying to find a reason to buy in here. And if you would have bought somewhere down here, price never really went and made a new higher high. It never started really forming the structure of a new uptrend. And instead, price tried for a while to break out to the upside before just falling back down. And then at this point, all you do is you would just draw an updated trend. So say price fell down in here, you would just draw like an updated trend. So that high to this high right here, and just extend it outwards. So price came there, came up to this area, started interacting with that. This also looks like a set of previous highs. So let's try to like get that as tight as we can. So somewhat tested there and fell, tested here 3 times, 4 times. This would not have been a bad trade at all. Like that would have been a perfectly fine trade to take for a sell, because you're trading with the downwards direction. Overall direction is downwards. That would have been, a downwards direction right there. And then, you just target the previous lows or something like that. This one wouldn't have worked out. And that's what's going to happen. Like, you're not going to win every single trade. As it sits with my system right now, it's between a 60 and 70% win rate if you're doing like a 1-to-1. And obviously, of course, once price starts moving into profit, you can always just secure a little bit of profits and then let the rest of the trade run. And that allows you to capitalize on, stuff like this. If you were to take like a break and retest right here, it allows you to catch like the first chunk of the move, which may have been that right there. And then it also allows for like an exponential amount of profit potential if you're just letting like the winners run. So I usually just choose to book profit. Sometimes I'll let something run if it's like in a very clear trend and it's just aggressively moving in one direction. But I do like booking profits, because continuing to consistently pull profits out of the market, that's your cash flow. That's what's keeping you profitable, and that's what's making your, that's what's negating your losers and stuff like that. But you're only going to do it with a trend. And so I want you to understand that you're only going to make a significant amount of money if there's a clear trend. And so if the market is not clearly going upwards or not clearly going downwards on the daily or the H4 chart, then don't take trades. Because trying to capitalize off of a market going sideways, like trying to like take a sell here at the top, like the market, it'll bounce around, for a while, usually in ranges, and maybe you can get a trade here, as a sell. Maybe you can get a trade here as support, but it's going to be super hard because you don't have a clear direction. And one of the sayings goes is the trend is your friend. And that just means, if you just trade with the trend, you're probably going to be better off. It's a good saying. Obviously, nothing is guaranteed in Forex trading. There's no one proven system that has a 100% win rate. Nothing's ever going to work 100% of the time. However, there's a lot of truth to that saying. The trend is your friend. And so if the market's going in an uptrend and just respecting uptrend zone, just trade with the uptrend. If it breaks out below it and starts trying to go down, don't be quick to try to jump in the opposite side of the trade. If it starts going down, cool. Just let it start going down for a while. Let it form a clear new trend. And if that's the case, then you can look for sells. But oftentimes, if it breaks out of those areas, it'll play around before then going back up into its trend and then continuing upwards. And this would have been a fake out that would have got everyone to like sell during a clear bullish direction. So you don't have to be too technical with it like that. So let's go back to what we've learned in this video. Whenever you're drawing trends, draw them where they make the most sense on the chart to you. If it's too confusing, delete the trend line, go to another pair, do not trade that pair. Because the best trades that you're going to get are trades that are going to be so easy to see, such a clear, it's just like a super obvious trend. Price is clearly respected it like 7 times in the past, and then price is coming to it, again for an 8th time, and it's showing like, rejection at that level. And it also happens to be, a break and retest of a horizontal level. Stuff like that just sticks out like a sore thumb on the chart. Stuff that takes you 30 seconds or less to analyze. Those are going to be some of the best trades you take. Anything that takes you longer than that or makes you second guess yourself, having you questioning it, looking at it like a million times a day, just don't trade that stuff. Delete everything off your chart. Go to something that's easy and make it a point to force yourself to only do the easy, simple parts. If you remember at the beginning of this whole module where I talk about simplicity and why, keeping things simple, in my opinion, is the only way to go, this is why, is because it nearly eliminates all of that confusion. So only the clearest trends. And you'll find 1,000,001 different trends in the chart whenever you look. That's why I emphasize just going to the daily and looking for stuff like this. which is clearly going upwards. So since you know it's clearly going upwards right in here, all it really comes down to is just drawing a trend line in an area that makes the most sense. So for instance, that right there, you could also test it out with like another one. Maybe you can start from that low and draw it like that and see if that's working. Or you could like start from this low down in here, connect it to that low, you know, and then it looks like in the future that one would have ended up coming into play, and then you could have adjusted that, you know, right there to like do that. And you know, we had a nice bounce there, a nice bounce there, you could have made some profit off of. And so just work with what price is currently doing, and then draw a couple areas in the chart that you like, and then whichever one looks the best and looks the most refined, that's the one you should pick. So in this case, let's see what I would have done. Yeah, I would have deleted that one. Everything else off the chart that's unnecessary at the time, because if price is up here and not over here, you don't need to look at over here. So if price would have been right here, that looks like the most well respected, like 1, 2, 3 bounces. And then right here would have been like a resistance area, because price bounced there, you know, once, twice as resistance, broke above it, tested it and bounced, came down here a second time, retested right here, started bouncing. So, you know, as price started going, you could have used the idea that, hey, price has rejected the trend, and then it's also broken above and retested a horizontal level. You could have simply looked to take a trade right there. Your risk will be somewhere below the horizontal level and somewhere below the trend. And oftentimes what I like to do is put them below like the previous lows, because if price is breaking previous lows, probably means it's not going to be in that trend anymore. Sometimes you'll need to give the trade room to breathe, because like, you know, like price may come down below the trend a little bit or spike down there, but then just go right back up. And you don't want to get stopped out and miss out on a really good trend just because of some little stupid technical thing that the price just spiked down there really quick and stuff like that. So yeah, trends. Keep it very, very, very simple. Experiment with a few levels on the chart first, you know, maybe 2 or 3 trend lines, and then pick the one that looks best. And you're just doing this in the daily and the H4 over and over. Let's look at my charts right now just to identify, because now you guys have been through horizontal levels and trends and everything. Let's go over to, so here on the daily chart, New Zealand dollar USD. There's my resistance right there. I just connected these highs. Here's my support zone right here. And then these are the levels I was looking at as price was making all this happen, like back in November. And then if we go to the H4, that's where the real magic happens. If you see, I've even left 2 different trends here on the chart. And these are 2 of the trades I've taken. I took this trade right here, and this one was closed at break even. And then I took this trade right here, which was a nice winner, ended up going right into profit. And all these were just based off trends. So here on the daily, I had this trend right here. But then if we look more closely on the 4-hour, price was in more of an aggressive uptrend here. So I drew one line right here, which you see. And then I also drew a second one right here, connecting that low to the extreme low right here. So that way I know that if price came into the future, it might find support at that trend line as well and start bouncing. So I want it on my chart just in case to keep an eye on it. And then what happened as price was moving upwards? Well, we're only looking for, you know, breaks and retests of levels for trades. So price had gotten above all these highs, broken above, tested once right there and bounced, a second time and bounced right there, a third time and bounced, and then a fourth time it bounced along this uptrend line, which is just this one right here. And when it bounced along that uptrend line, that's when I looked to make my trading decision. And so like I took a buy right there. I had a stop loss below this horizontal support zone. I had my stop loss below this diagonal trend line and also below this future trend line, just in case price decided to come all the way down to that trend line and then bounce. My stop loss was below all that. My target was at least a factor of 1 above that. And this one actually ended up closing just before Christmas Day. Where was it? 24th of December. So just before Christmas Day, I closed that one, and that would ended up going all the way to the original profit target. So, but yeah, this is a trade I actually took. Let's look at one more. Euro CHF. This is a trade I took, and I closed it in profit the day before Christmas, because like now it's like December 26th. It's like one day after Christmas. So I didn't trade Christmas Day, and I closed all my trades on Christmas Eve, just because the market's typically a little bit slower Christmas Day, because you know all the banks are off, they're with their families and stuff like that. So the market's not, you know, as fast as it normally is. It's usually a little bit slower. So I just got out of all my positions. However, let me look at this trade I took. Like here, if we're looking on the daily, overall, you know, price is going downwards, and it went sideways for a while, and it started going downwards again. On the H4, which is where I made my trading decision, like look at this trend I found. I just simply connected that high and then this high and this high and this high. Like that's clear as day. And then what also happened is at this horizontal level right in here, like this was a previous low bounced to support, broke below this area, came up and retested as resistance and started to fall. After it started to fall, all that is a break and retest of that horizontal level combined with a rejection of the downtrend. And that was it. This was just a break and a retest within a clear downtrend. Like that is, there's nobody you can debate with and say that high and that high and that high and that high, that it's not in a downtrend. Like there's lower lows and there's lower highs. So there's that. And then it was a break and retest this level. I took this trade for a sell right after it started rejecting away, went sideways for a little bit, went into profit. And then I closed it right here as it was in profit on, where was it? December? It was December 24th. So I guess maybe right in here. So it was like, a little bit of profit. It wasn't much. It was like a couple $100. It was like nothing. But even then, like this was still a really good trade because it was going in a downtrend and broke and retested. Let's see like another Euro New Zealand dollar. So here's a trade. So this one I would have had to dip into the 1 hour to see. But the only reason I dipped into there is just because of this one right here. But in the 1 hour chart, you never want to be drawing your levels based off the 1 hour. You really just want to keep it on the 4 hour if you're new, because it's just so much simpler. But this was essentially like there was a horizontal level right in here. So that was the set of lows. Price broke below it, came up and retested as resistance and started falling away. And so what happened is I had planned on taking this trade, but I never actually got to enter this trade because I missed my entry. And by the time price was reversing, it was all the way down in here, and I just didn't take my trade right there. But it's the same idea. You see, like I just drew a line connecting all the highs in a logical area, and price was going down. Same thing with these trades right here. So this is like a horizontal zone. So price broke that area, retested it, started going down. Meanwhile, I just connected all those highs. And if you want to, you can even extend it to connect that high too. But it's just bounced once, twice, 3, 4 times. Broke below those lows right there. Came up, retested as resistance with a few wicks. I missed my entry on this trade by like 1 pip, so I never took that trade. But later on down the line, price came in here and got into like a new downtrend, and it was also a break and retest of this low right here. Price broke below and tested, with a lot of wicks, with a lot of resistance. So I took a trade after this as well. Price was just in a downtrend and it had broken, retested a horizontal level. And this one went right into profit. Like the next morning, I woke up after London session and it was in profit. It was good. So that being said, what you've learned about is you've learned about horizontal levels, and you've also learned about diagonal levels. And one of the big takeaways from this video as well is keep it as simple as possible. Draw a few lines first, on the chart, a few levels if you need to, a few different angles, and just pick the one that seems to work the best. And then whenever you're trading these levels, which is what you're going to learn in the break and retest section of the course, you're going to learn how to use these levels in Confluence to make your trading decisions, exactly where to enter at, exactly where your stop loss goes, where your profit target goes, and stuff like that. So that way you know how to use these levels to actually trade. So we're going to cover ranges in the next video, just so that you're aware and that you know what they are. And then we'll get on to actually how to enter the market. So cheers. See you in the next video.